It's super easy to invest in the S&P 500, in gold, and even in currencies, bonds. Everybody can do that. Let's take a contrarian look at things. I've invited Trader Ferg onto the program to discuss contrarian investing. He's the contrarian investor. He looks at commodities barely anybody glances at, but that's where the opportunity lies. And I've often asked guests on this program, like, where should we be looking? It seems to be getting dire out there. Economic indicators are struggling, and we're looking for opportunity in a desperate market. So who better to ask than Trader Ferg here for some contrarian ideas. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously, and we much appreciate it. And have I mentioned, it's free to do that. So thanks so much for doing that. And it's a great pleasure. Trader Ferg, great. Thanks so much for coming on the program.
Thank you for having me on. Pleasure to be here.
Yeah, really looking forward to the next 30 minutes here with you, looking at some the contrarian investment plays in the commodity space, or in general as well. But before we dive into some of the details and what you're looking at in particular, run us a bit through your investment philosophy here. Like, how are you approaching things?
Yeah, so my investment philosophy is built off my mentor, Brad McFadden, really. He showed me the reins, and it just suited my personality as well. So I just hang out in really hated areas of the market, like stuff that I inherently know is cyclical. Like commodities are a great example. You can see that areas being left for dead. It's generally, I love the charts that are just crawling along the bottom of the screen. Kind of refer to them often as like a patient's heartbeat, and then the patient's died, and you're just looking for that sign, any sign of life again. And that's where I largely hang out. And I just love trying to hunt out those inflections, finding areas that I think will matter a lot in 3-5 years, and that people just don't have the patience for, can't touch them because they're too small. They're on exchanges that everyone's forgotten about. And pretty much my edges are having that longer time view and going places the big boys can't, and then just hanging out there, waiting for what I like, an inflection and the sort of some of the mistakes I see in the world to sort of it's essentially the sort of, I see a whole lot of fallacies, like kind of like the net zero. I don't think that can happen, and so I'm just waiting for reality to bite with something like that on a longer time frame. And so I'm generally trying to take the other side of a lot of it's ideology, some of it's just time frame, just knowing something's cyclical and assets are aging. But yeah, looking at my portfolio at the moment, probably a big chunk of it is around taking the other side of this whole sort of net zero ideology the last few years.
Yeah, no, it's really interesting because you've been a trader for 9 years. So I'm curious, like when you talk about time frames, how patient are you? Because I know you're looking at uranium, coal, oil, which is more volatile, obviously, but coal in particular. Like, what are the cycles like? And you've been in it for a while now. Like, what are your time horizons there, Ferg?
So I've just noticed, like, whenever I get into something, generally it takes I generally experience a lot of chop at the start, and then seem to sort of make the majority of my returns in like year 3 on. So quite often get chopped to bits, have a drawdown, and then once it starts working, it can really take off for me. And it's that getting in cheap before, and this is a conversation I constantly kind of have with other people, is like, when's the perfect timing? Because being too early is obviously extremely painful as well, especially if you're in certain companies that can dilute you and do a lot of dumb stuff. So like a perfect example of this that I often think about is platinum chart. Like, it's fine to say platinum was a interesting investment case, but the chart pretty much went sideways for nearly a decade. And so anyone that's pitched platinum as an investment, generally, if they were managing money, they've had money taken off them, because you can't have that sort of underperformance against the S&P shooting the lights out year after year. And then, if you waited for like the actual breakout, it was pretty explosive. It sort of did 40-50% in a very short time. And so now your asymmetry is reduced, but now you know the thesis is kind of inflecting in the spotlight more. So it's constantly going back and forth between those two, risking being too early and trying to get close enough to the inflection, or even buying as it's breaking out, so that you don't lose too much asymmetry. Like it's a big difference buying something before that massive breakout. Like makes a big difference to your returns over a long time frame. Getting in that little bit earlier.
No, absolutely. Timing is everything, of course. What is it? The markets can stay. I can always mess up that sentence, but the markets that can stay. What's that saying? I keep messing it up. The market can be wrong.
Irrational, larger than you can say solvent. I think. Yeah.
Right. So
yeah, and
exactly.
I had in a piece recently that was the what was it? The AMC. The shorters were like, we can stay retarded longer than you can stay solvent. Just carried out all those.
Yeah, we just keep investing into gold mining companies. Fooled you. Yeah. Right. No, it's interesting because you're mentioning timing and everything, and we have a new president in the White House, and we've often discussed policies and everything on here. But from a contrarian point of view, you must feel quite vindicated of the last, 6 months or 7, 8 months here now, how things have changed, like how the spotlight has been moved towards more that net zero. Like you mentioned, net zero doesn't really make any sense. Let's strengthen our economy. Let's strengthen our industry. There's a complete rethink of things happening. How has that changed your investment philosophy and style with the new policies?
Well, it strengthened my view because you see, the piece I just put out was essentially a company that was really pushing the sort of renewable angle, and with the subsidies being reduced, pretty much removed on a lot of wind projects, and the economics of them collapsed, and the company's revenue with it. And so I think with that being removed, it's actually quite an interesting play moving forward. And I just see that across a lot of, like, you've got like the IEA that are forecasting that won't need that much oil in the future. They've chronically estimated sort of energy demand growth across the developing world. And now we're in this interesting point where even that we've seen all these policies fail, and I don't think it's really debatable that we're like on any sort of a course to achieve net zero, and yet sort of capital still being largely allocated, like all that extra demand won't show up. Like you mentioned coal before, and coal's probably the craziest example of this. Is in OPEC and IEA, EIA, pretty much any forecast you can find, all the major agencies, they still always expect coal demand to really roll over, and renewables, particularly across Asia to represent a large amount of the primary energy, which you can just look at like what's in the pipeline. Look at a lot of this is not even making big forecasts. It's just saying like, well, what are they actually building? And largely they're still building coal plants like crazy. And so I don't think it's that hard to just say their forecasts are wrong. And as a result of those forecasts being wrong, like what stuff's been underinvested in, and all things being equal, what will do really well over a longer term time frame. And that's part of the trick as well, is like no one really cares about the stuff when you're talking 3 to 5 years out. Like every money manager, anyone that's even survived in active management has had to put up good numbers on shorter time frames, really, because they're sort of fighting for their life with against passive, and then if they are active, then they've got to compete with everyone that's been doing so well in like the tech sector as well. So I'm sure everyone's seen the passive to active kind of flows, and active just got smaller and smaller, and more money is flowing to passive, and then the active that survived has generally been in the stuff that's been working, which just means the sort of value commodities, it just gets smaller and smaller and smaller. And I just find that really compelling across the board. Granted, got to be careful just buying cheap stuff, because I've done that before and it just gets cheaper and cheaper and cheaper. So you do have to have some inflection, some thesis that'll matter on some sort of a time frame, because there's a lot of stuff out there that's cheap and will probably still be cheap in years to come.
I was going to say, like, run us a bit through a recent example or so where you decided, okay, it's time to enter now. Like, what did you see that made you like sort of, okay, this is the right time now? You mentioned platinum earlier. It was sideways for 10 years. You could have been wrong for 9.5 years, and then all of a sudden that pop happens. Run us a bit through an example there. Like, what does your process exactly look like?
Yeah, so platinum's an interesting one, because I So I started first buying a few of the companies last year, and then kept kind of scaling into it over the last few months. And I think the best example, Platinum, is the recent Platinum Investment Council put out their forecast. I think this is like 2-3 months ago, and they were seeing mine supply rolling over at like 6% per year. They had the most bearish like demand assumptions. Like they had industrial, so for platinum it's pretty much a third. If you had like auto catalytic converters, jewelry, investment demand, and industrial demand. And so they were massively bearish. Industrial demand, like, saw that down. Their forecast was 15% year on year. They saw catalytic converters, they were bearish on that. They thought that was down sort of 2% a year. And jewelry and investment was the only one that they were slightly positive. And this was also against a backdrop of recycling disappointing and primary mine supply rolling over, which I've done quite a bit of work on, sort of going through where the deposits are and how quickly they're depleting across South Africa. So for platinum, the vast majority of it comes from South Africa. And going through all of that, you kind of look at the model and you're like, the supply's in trouble, demand is super bearish. If anything goes right, this is going to shoot the lights out. And sorry, and I should mention that above ground inventory was drawing down at a rapid clip. And I think it's actually even worse than what the market's kind of taking into account, because the remaining inventory is largely held by China, and they don't export the raw material. They only give it to their domestic producers, and they can export it with value added. And that's down to, I believe it still is, like sub 3 months now, which is like a real historic low. And then there's a lot of countries that are now living sort of almost hand to mouth with their platinum requirements, when coming back to the problems in South Africa and their mine supply already been in decline. I'm just like, when I find a setup like that, I'm like, I don't need much to go right for this thing to shoot the lights out. And you're also getting into a metal that just has historically been valued higher than gold. And so that was broadly the thesis, was that everyone's so bearish. If anything goes right, this will start to really perform. And the only thing that really went right was the Chinese, with gold outperforming. The Chinese have started buying it in size. There's been substitution started. And so it's just that 1/3, the investment in jewelry has really kicked off. And that's largely what's driven this price action. And I just see this having multiple legs, as I'm quite bullish on developing market growth over the next sort of decade. And I think that comes with a lot of new vehicle buyers, with how crazy competitive the Chinese auto industry is now, and a sort of misconception that it'll be all sort of battery electric vehicles, where I think hybrids will play a big part. So that'll drive catalytic converter demand. And just industrial, like anyone can pull up a chart of platinum and how closely tied it is to kind of emerging market growth as well. In the last cycles from 2000 to 2008, that sort of almost, they were highly correlated chart. So I think that minus 15% year-on-year growth is going to be very wrong. And yeah, that's when you just see a breakout. And it also ties in my sort of belief as well. This is borrowed from my mentor. The longer you get like a tight basing pattern, often the moves are really explosive when you break out of a sort of a sideways trading pattern. And this one is probably the longest one I know of, been from sort of, coming up 10 years of sideways trading.
No, interesting. Platinum is really interesting, as you said before. You're not the first guest to mention platinum still as an opportunity, not just a contrarian play. I think you're the third guest in the last 2 or 3 weeks that has mentioned platinum as a massive opportunity. It's an interesting one, because you're mentioning people are starting to substitute gold for platinum, or platinum for gold, because it is still cheaper and has to catch up. Because platinum, and one of the guests mentioned, I think it was Clem Chambers here on the program, that said usually platinum is more expensive, or at least equally as expensive as gold, but it's still trading. Yeah. I don't know the exact platinum price. I have $2,000 in my head, but I might be completely wrong. But it's trading at almost like 2/3 of the valuation. Is that correct? Like, will it catch up to that again?
Yeah, well, like historically, it's traded like it's a scarcer commodity than gold, so it should trade at a premium to gold, and yeah, it hasn't. And then you also get into, like, I'm not buying it purely on the speculation that it's going to catch up and overtake gold, because gold's got some interesting, like, there's the whole theory that it's going to be used to largely recapitalize the system, because the fact it's not tied to anything, so you don't break anything in the economy if you revalue gold to 10,000, 20,000. So I think there's a solid case for that, and I try and capture that with, like, holding a basket of, like, junior gold miners, because I still think they're super hated. But with platinum, I see it as sort of a just a play on the, like, all the demand being, like, the demand sides. Yeah, they can't make the market balance with the most bearish demand assumptions. And so whenever I've seen that in my time, I know how that generally plays out. Supply keeps getting destroyed and demand will not turn out to be as bad. And even if it is really bad, even if we end up with a hell of a crisis, if you kind of take it to second level thinking, I think a lot of money will be printed to get us out of a crisis, and you're still sitting in a metal with scarcity. So it's where you'd want to be even in a crisis anyway. So.
No, which is, I just looked up the price chart for platinum. It was completely off on the price. It's 1335 right now. So
yeah,
completely off, not 1900 or 2000, as I said before. So it's got lots of room to catch up just to get to equilibrium, yet alone a premium, right? Interesting. I keep using platinum, but it's a really good example just to run through the process. You mentioned that you're looking at stocks, like miners in particular. Like, how do you enter, let's say, the platinum trade? How do you enter it? How much is it physical? In gold, of course, it's bullion, but on the physical side versus just mining stocks for more torque, I guess. Like, how do you sort of split that investment?
Oh, so I guess, what the thing to talk about with platinum as well is my largest position on platinum isn't actually even platinum. It's on a sort of the byproduct of platinum, which is rhodium, which is a far smaller and more illiquid market. And that's it's largely a byproduct of platinum mining. Like, you can get rhodium from palladium mines, but it's far lower levels, lower percentages. So the vast majority of, I believe it's in the vicinity of 85% of global rhodium is coming from platinum mines within South Africa, platinum dominant mines. And this is just the extension of the platinum thesis, in that I think rhodium being a byproduct, it's really hard to bring on additional supply. The mines where it's most abundant are in heavy decline. And I see within that section of platinum demand, how I was talking about jewelry investment, catalytic converters, and industrial, rhodium pretty much purely the catalytic converter. And I see that surprising to the upside with lots of new car buyers across developing markets, particularly Asia. And that's sort of an example of, like, just taking the thesis one step further, going really niche. Rhodium's really difficult to get your hands on. I sort of own one ETF that was a prick, like a physical ETF of it. That was a prick to kind of manage to get access to. And so, yeah, it's a lot of it's stuff that's just, it's another level. It's more niche, and it's not something that you're going to get access to easily. But as a result, when it starts to work, rhodium's a perfect example of it, because it's not many people own it. It's a byproduct, so supply can't really be increased very much, and so people just have to pay up for it. And it's highly illiquid, like the market's tiny, and so it's highly cyclical. And when it runs, it just shoots the lights out. Like, it's got, anyone that's studied its history, it's had 5 bull markets in the last 40 years, and the average one is like a sort of somewhere up around a 10 bagger.
Yeah. Crazy. No, that's, of course, chasing dreams there. That's what every commodity investor is looking for, right? So,
yeah.
No, really appreciate that. Like, platinum rhodium was a really good blueprint to sort of cover your investment style and understand, like, how you operate and think. I want to cycle a bit through the commodities. I know, because you're following uranium, for example, as well. I know that's a hot topic. What do you make of the uranium market right now? I'm just looking at the price chart here. $72 a pound right now. It's been much higher, but it's also been lower before. What is the uranium market right now? It seems to be neglected as of late. It's not that, I don't know. It's an interesting one.
Yeah, so it's just frustrating because you still have an airtight thesis. You just have an opaque market when you don't know when utilities are going to come to the table. So the uranium thesis was always essentially you need utilities to start buying at replacement rate. Like everyone looks at spot, but that's because you've only got the spot to look at. You can't really see term contracting. Like that's all done behind the scenes, and a lot of it they don't actually report what was signed, and if they do report, they report it in a way that's just crazy, sort of the lowest offer rather than what the deal was done at. And so my big picture view of uranium is the thesis is still intact and airtight, but the way to apply the view is just really painful because the miners, pretty much every producer's had issues, missed guidance, had run into problems, and so the actual application of the view has been extremely painful for anyone that didn't time it well at the start and write it up, and then honestly take profits, because just the volatility of holding a lot of stuff has been extremely painful. But then that as well doesn't detract from the point that every year that the utilities aren't coming to the table, they're going to have to contract more to hit their replacement rates. And historically, they don't just contract at the replacement rate. They contract at 120, 130, 140% of their replacement rate. And at the same time, the deficit's getting bigger as well, because the flip side of all these developers and early producers kind of missing guidance is they're not bringing on the pounds. And yet, for whatever reason, the market sort of thinks everyone that provides guidance when their mine will come on, they're all going to hit it perfectly, when the reality is everyone's screwing it up. But like Cameco's probably been the only one that's been really executing. And so it's one of those funny markets where the bigger picture thesis is still really intact, but just people have been chopped to bits on the application of the sort of the thesis with getting involved in all the miners. Has just been nothing but pain unless you sort of timed it really well.
Like, I've always been cautious with uranium. Like, I fully understand the thesis. I love uranium. It's the cleanest form of energy, in my opinion. It's just the most efficient one as well. SMR is coming on, like they're developing and getting more widely accepted. So the thesis is intact. What I struggle with is, where does the supply come from? Like, why is Sprott Uranium ETF buying millions or hundreds of millions of pounds or dollars worth of uranium, and the price just barely move? Meaning yes, we moved from $30 a pound to 120, and now we're back at 70. I get that part, but in my opinion, it should be way higher based on just the amount of uranium they've been gobbling up. But it's not. That's what I'm struggling with. I don't understand that. Where is the supply coming from, really? Like, yes, you mentioned Cameco is doing well and others, but there seems to be an unknown factor that I'm not aware of, and that's what has me scared and shy away from the market in general. Can you shed some light on that and try to educate me, maybe bring me to the table?
Yeah, well, that's a great point, because that was I was surprised how quickly the price came back down with Spot after Sprott Uranium Trust raised their money, went out and bought pounds. The fact that it just rolled over shows there's still a decent amount of inventory out there. I've seen lots of charts that show sort of commercial inventories rolling over, and sort of even volumes dropping, but it's yet to hit the point at which it's kind of, as you say, dried up. There's just always been more flexibility in contracts. There's always been more pounds available, and it's been a real lesson for me in thinking that you've got any insight into how much inventory is floating around out there, and the fact that it just you can know that it's not being mined, but you've got no insight with an opaque market as just how many pounds are available, and how long this game can go on of kind of avoiding having to get it from sort of primary production. And it's frustrated a lot of people out of the trade, and I think a lot of people did throw in the towel when they saw the price come back down after Sprott, because like there was the already had it when Sprott first sort of started buying pounds, and that caused quite a rip and a rally in the whole sector. And I think everyone was hoping for similar. I certainly was, because I also was seeing just the amount of short interest across a lot of the names. And I was thinking, like, God, if these, if we have something similar and some of the names are up to sort of 20% shorted, then that would be real fireworks. But yeah, as I said, there was more pounds out there and rolled over. And if anything, the short interest is going up on some of the names that have already been really hammered. So the shorts are pushing again, which is, it's got to step back and say, like, what do they know if they're willing to increase short interest when the stock's been cut in half? Yeah.
How many legit mining names are out there in the uranium space? And I know there's a ton of juniors that always chase the dream of $150 a pound uranium that become all of a sudden legit. But how many do we really need, and how many of them are legit? And you don't have to mention names or anything. I'm just trying to get a sense. Like, is it 100? Is it 10? Is it 1,000? Like, how many do we need? How many are out there? Like, I'm trying to sort of separate the wheat from the chaff a little bit.
Yeah, there's not many mines that'll really move the needle. Like, if you actually go through the what needs to come on, like, you're really just talking next gen, like that's the sort of size needed to plug the deficit out a few years, and then from there everything else is kind of like little bits and pieces. Like, you've got obviously got a few, like, what have we got producing? Got Paladin, got UEC's not too far away, got there's not many pounds actually. Like, as I was talking before, like, it's just been nothing but disappointment with those even trying to ramp up. Even Boss has been absolutely murdered and retracted guidance moving out a few years. So it's the guys actually trying to produce are getting killed, and all the ones promising to produce, like, I kind of quote John Borshoff, who was he founded Paladin and brought it to market, and he always just absolutely bags on the sort of all the guidance given by all the sort of juniors and developers, saying, like, in the last bull market, I saw dozens of these presentations and we were the only ones that got into production without the help of, like, a major or sort of a JV, I think. And so the fact that, uranium mining is super hard, and the guys that are at it and honestly have experience at it are just having so much issue. Like, you just have to look at Paladin. It's just had nothing but problems, and that was an open pit mine that's they've got experience operating. Like, a lot of this other stuff, like ISR, has had to be proven out, and that's similar to Boss's. The original, when it was under Uranium 1, they had issues, and now now they're having issues again, and makes it hard as an investor when you maybe as I say, they're just going to keep promising that they'll get production up to a certain level and keep having those issues moving forward. It makes it hard to model it.
No, absolutely. No, look, Ferg, you've shared a lot of practical advice for our audience already, so I don't have to ask a summary question, like provide some practical advice. I'm going to ask you, what is your boldest prediction for the rest of the year? What should we be looking at? What's your biggest, or not biggest bet, but where would you put your money right now for the rest of the year?
Well, I think we're in, like, a tricky point at the moment, because I see there's a long runway for a lot of this stuff, but we're in it's kind of disconcerting seeing everything sort of, like, absolutely rip all at the same time, like all this sort of everything across US indices, even the garbage is kind of going higher. And so that makes me really pause, because my longer term view is we're going to have inflation, like everything I see happening. Like, the deficits, they're not, the whole Doge thing's been obviously shown to be a bit of a farce. They weren't serious about bringing it down, and so I think it's going to be a case of print the difference. And so you want to be in real commodities, but also if we get into another sort of liberation day, then a lot of stuff's just going to get beaten up if you're in miners. And historically, what's happened when inflation comes up is a lot of the multiples have to come down. Everything has to compress till it makes sense with sort of a higher inflation environment. And so I've kind of been looking back through the portfolio at the moment and sort of saying, what is stuff that even if we get an absolute sort of another Liberation Day thrashing, I'd be happy holding, and I know it's just going to have a massive tailwind out the back end, or do I want to carry more cash as well? And with that, like, come back to sort of the ideas of having more physical, like having sort of physical rhodium, even physical platinum, having physical uranium, and being in areas where there hasn't really been hot money flows yet, like gold miners, junior gold miners especially. Like, there's just been, even though they have run up, there's still, like, you can just look at the ETF inflows, there's still outflows out of the ETF. It's still absolutely hated. Or you go to the likes of coal names, where if you're trading it a few times cash flow, that's why coal has historically been a great performer in higher inflation, because if you do think of what's the opposite of like a long duration asset, like kind of like a real shit tech company that's just burning cash and doesn't know when it'll ever make a profit. The opposite of that is like a coal company trading a few times cash flow, selling on spot. Like, that's like the shortest duration. And so they do really well. And I've got a kind of a whole view on how strong Asian growth is going to be. I think that's going to be the real growth engine moving forward. So coal's going to play a big part of that. Some other stuff I like tin. I think tin's going to surprise everyone moving forward. There's just not enough supply, and demand's going to hold up. Love oil space. Got a ton of exposure in sort of offshore oil and oil services, and even building up some exposure in sort of the oil exploration, the sort of seismic plays. And it's one of my bigger aims, is to try and reduce the miners in, because if we get another sort of real bust up in the market, miners just get murdered. Whereas if you have the likes of more physical commodities, or you have kind of higher quality businesses which have just been capital starved, which I think the seismic companies are a good example of that. They're quite tech focused, and there's just been, with the whole net zero push, there's been the idea that we won't need any more oil. So why would you invest in them? And I think that's going to change moving forward. So yeah, a few areas.
Lots of great ideas in there, Ferg. Really appreciate that. Really comprehensive. Appreciate that very much. I appreciate you coming on to the program, Ferg. It was great to have you on. We'll have to catch up maybe later in the year, because we haven't had a chance to talk tin, tungsten, some of the really niche metals. Like tin, there's probably 2 miners you can buy these days that are worth investing in. One of them just paid a handsome dividend as well. So we'll have to catch up on that. But in the meantime, where can we send our audience to follow more of your work, Ferg?
Just my Substack, Trader Ferg. That Substack is pretty much where I do all my writing, and put all my thoughts out now. I don't really spend as much time on Twitter or X anymore now that the bots have taken it over. Just Substack, and I send out a free weekly email with a few things I'm finding interesting, sort of most interesting article, podcast, quote, chart, and it's the easiest place to find me.
Fantastic. Yeah, I've seen you've got over 16,000 subscribers already on Substack. So maybe we can add a couple more. But really appreciate you joining us, Freg. It's great to have you on. Great contrarian discussion. Really appreciate you running us through your process here in general. So thanks so much for that, Ferg. Everybody else, thanks so much for tuning in to Soar Financially. A bit of a different discussion today, because everybody can talk about the S&P 500 and gold. We talked about contrarian investments. Platinum we used as a case study here on how to look and approach contrarian investment ideas. He's highlighted a few others at the outro here. Tin, tungsten are a couple that could be worth following as well. And really appreciate your feedback in the comments down below on this conversation. How are you positioned? What is contrarian for you right now? What are you looking at? Is gold still contrarian for you? We're really curious. Let us know. Don't forget to hit that like and subscribe button. We much appreciate it. Thank you so much for tuning in. We'll be back with lots more. And we'll be back in the studio next week again as well. So take care out there.